During the last 1 week period, rupee registered a low and high of 73.7750 and 73.1500 after opening the week at 73.39. The rupee is currently trading in the range between 73.30 to 73.60. The dollar supply and demand in the market is almost matching, leaving a little scope for the rupee to move out of the above range. In the next 1 to 2 months time frame, the market is expecting to receive dollar inflows from FDI, PE and other current account flows. In the absence of RBI intervention at that point of time, the excess dollar supply in the market would make the rupee to appreciate and test the next resistance at 72.50 level. Barring any sudden and unexpected developments in the internal and external front, the rupee's depreciation beyond the 74.00 mark looks difficult over the short term. But the probability of its appreciation to 72.50 level or so is very high. The market is positioning itself to trade the rupee higher, anticipating huge forex inflows into the market. The appetite for riskier assets has increased due to rising prospects of a COVID-19 vaccine diminished the allure of safe haven greenback. Already, the Asian currencies have started to appreciate against the dollar, indicating the initiation of risk-on trade in the market. The appetite for riskier assets would also influence the rupee to rise against the dollar, more so in the background of anticipated capital inflows into the market at some point of time soon. Exports fell for the sixth consecutive month at 12.66% in August at USD 22.70 billion. Imports in August were USD 29.47 billion, leading to a trade gap of USD 6.77 billion in August. The current account is expected to end the current financial year with a surplus. For the third consecutive day in the past week, the rupee tried to breach the 73.75 level decisively but could not succeed. In the event of a clear breach of 73.75 level at some point of time, the rupee can gradually move lower to test the next support at 74.00. Weakness in the rupee exchange rate beyond the 74.00, 74.30 level is quite unexpected as of now, and we feel the rupee's weakness can be considered as only temporary rather than any trend reversal at this point of time. OECD forecast a deeper contraction of 10.2% for India in the current fiscal, surpassing its June estimate of minus 7.3% in the event of a second wave of infection. As a result of US Federal Reserve's upbeat assessment of the economic recovery, the 10-year US T-bond yield rose to 0.70% on Wednesday last week, but it fell by 2 BPs to end the week at 0.68%. As a result of Fed's zero rate policy, the 3-month and 6-month USD LIBOR slid lower to 0.23% and 0.27% per annum respectively. The 1-year USD LIBOR fell by 8 BPs in the last 1-month period. As a result of the rupee's moderate weakness against the dollar in the early part of the week, the forward dollar selling by exporters was seen, and the forward up to 6-month maturities have dipped due to strong receiving interest in the stock market. The 3-month and 6-month forward dollar premia slipped lower and ended the week at 3.92% and 4.02% per annum respectively.